There exists a threshold in the architecture of wealth, an invisible boundary that, once crossed, fundamentally alters the relationship between human effort and financial reality. This boundary sits at precisely $1 million invested, and what transpires beyond it resembles less an incremental improvement than a metamorphosis of economic identity itself. Consider the paradox. Millions navigate their financial lives believing wealth accumulates linearly, that $200,000 represents merely double the utility of $100,000, that $1 million is simply tenfold the value. Yet this conception crumbles upon contact with mathematical truth. Money, at scale, operates according to different physics entirely. Certain thresholds exist where the fundamental rules governing capital transmute, and the $1 million mark stands as the most consequential transformation most individuals will ever witness. What manifests at this juncture transcends mere numerical achievement. The individual does not simply possess more money, they undergo a categorical reclassification within the economic system itself. The transformation converts one who exchanges time for currency into one who commands capital that generates income autonomously. This distinction extends beyond philosophy into the realm of mathematical certainty, reshaping every dimension of existence: how one labors, how one perceives risk, how one inhabits time itself. The mathematics reveal a stark asymmetry. $10,000 invested at 7% annual returns yields approximately $700 yearly in passive income. Pleasant perhaps, but hardly transformative. $50,000 generates $3,500 annually. Helpful, certainly. Yet the individual remains fundamentally tethered to employment for survival. But observe what occurs at the $1 million threshold. That same 7% return now produces $70,000 annually, requiring precisely 0 hours of human effort. $70,000, exceeding the full-time earnings of countless workers, manifesting without commute, without supervisors, without the myriad indignities of conventional employment. The average American household expends approximately $67,000 per year. Thus, at $1 million invested, capital ceases merely to supplement lifestyle. It potentially sustains lifestyle entirely. The invested $1 million becomes, in essence, an employee working ceaselessly, through sleep, through vacation, through every moment spent with loved ones or pursuing passions. This marks the inaugural threshold where, for most people, capital begins to outperform labor. And once this line is crossed, everything about one's relationship with money undergoes fundamental reconstruction. The psychology shifts from saver to capital owner, distinctions that sound subtle but represent entirely different existential realities. The saver remains fixed on accumulation, each dollar precious because it builds toward something yet unrealized. Financial strategy focuses on offense, constantly seeking methods to earn more, save more, reach the next milestone. But the capital owner with substantial assets pivots entirely toward preservation and optimization. The objective is no longer to become wealthy, but to remain wealthy, a pursuit demanding completely different skills, strategies, and psychological frameworks. The mathematics alone revolutionize one's entire perspective on risk. $20,000 invested, subjected to a 10% market decline, costs $2,000. Painful, but recoverable. $1 million experiencing that same 10% drop costs $100,000. Suddenly, market volatility ceases to be abstract numbers flickering on screens. It becomes tangible wealth capable of funding multiple years of existence. Yet here emerges a fascinating paradox most people cannot comprehend until directly experienced. Once significant capital is invested, market downturns stop resembling disasters and begin resembling opportunities. With $1 million generating income, one possesses the financial cushion to weather temporary turbulence. More significantly, one holds the capital to exploit situations requiring substantial upfront investment. This is where the wealthy truly differentiate themselves from everyone else. They deploy market downturns to acquire assets at discounted valuations. They command resources to invest in opportunities requiring considerable capital. They can afford calculated risks that might multiply wealth because they already possess enough to maintain their lifestyle. The relationship with work transforms utterly upon crossing the $1 million threshold. This does not necessarily mean immediate resignation, though some choose that path. Rather, it means working from a position of strength rather than desperation. When investments can theoretically cover basic living expenses, every career decision becomes choice rather than necessity. One can afford to abandon toxic work environments. One can negotiate more aggressively for better compensation, unburdened by desperation for the paycheck. One can assume calculated risks, launching a business, switching careers, because a financial foundation exists that will not evaporate if immediate success proves elusive. This psychological shift permeates every aspect of professional decision-making. Perhaps a position offers lower compensation but superior growth potential or better alignment with personal values. With significant invested capital, one can afford such risks. Perhaps the desire to start a business has long existed, but fear of losing steady income prevented action. $1 million invested does not eliminate risk, but provides a safety net rendering bold moves more feasible. The intriguing aspect: this newfound confidence often catalyzes even superior financial outcomes. Individuals unburdened by desperation tend to make better decisions. They negotiate from positions of strength. They undertake projects and pursue opportunities aligning with their skills and interests rather than merely accepting whatever compensates adequately. But perhaps the most profound transformation concerns how one conceptualizes time itself. While building toward that first million, every hour not spent earning or saving feels wasteful. One constantly calculates the opportunity cost of leisure. Once capital generates substantial income, however, a revelation occurs. One's time has become more valuable than immediate earning potential. This is when different choices emerge about how days are inhabited. Perhaps one works fewer hours or selects work that fulfills personally, even if compensation diminishes. Perhaps one takes extended vacations without anxiety about lost income. Perhaps one invests more time with family or pursues hobbies generating no revenue but providing profound personal satisfaction. The $1 million threshold also unlocks entirely different categories of investment opportunities. With substantial capital, minimum investment requirements that were previously insurmountable suddenly become accessible. Private equity funds, real estate syndications, business acquisition opportunities, and other high-barrier investments materialize as options. These are not abstract strategies reserved for the ultra-wealthy. These are opportunities becoming accessible once $1 million foundation exists, and they can dramatically accelerate wealth accumulation beyond what most people imagine possible. Many real estate investment trusts and private funds require minimum investments of $50,000 to $100,000 per position. With only $20,000 total invested, these minimums remain completely unreachable. But working with $1 million portfolio, one can allocate 5 or 10% to these higher yield opportunities without concentrating risk excessively. Leverage opportunities transform entirely as well. Banks and financial institutions treat individuals differently when substantial assets are demonstrated. Approval for investment property loans becomes easier when significant liquid investments can be shown as collateral. Business acquisition loans, typically requiring substantial down payments and proven capital reserves, suddenly become viable options. Yet here emerges something truly interesting, something that catches most new millionaires completely unprepared. The psychological pressure actually intensifies in unexpected ways. With $50,000 invested, losing 5% in a market downturn meant losing $2,500. Painful, but not devastating. With $1 million invested, that same 5% drop means losing $50,000. Consider that reality. One could lose more money in a single unfortunate week than many people earn in an entire year. Daily portfolio fluctuations begin exceeding most people's monthly salaries. This creates an entirely novel species of financial anxiety that simply cannot be understood until experienced firsthand. Individuals who reach their first million often become obsessed with checking account balances multiple times daily. They refresh portfolio applications compulsively, watching net worth oscillate by tens of thousands of dollars based on market movements completely beyond their control. It resembles suddenly discovering that one's financial future is tethered to a roller coaster that never ceases motion. This explains why so many who reach the $1 million threshold begin shifting investment strategies toward more conservative approaches. They begin prioritizing capital preservation over aggressive growth. The risk tolerance that facilitated reaching $1 million often differs substantially from the risk tolerance that helps maintain and grow that million. Asset allocation is reconsidered when numbers grow large enough to matter profoundly. Perhaps one felt perfectly comfortable with 80% of a $50,000 portfolio in growth stocks, but $800,000 in volatile investments might induce insomnia, even if the percentage allocation remains identical. This shift toward preservation is not merely emotional, it is mathematically rational. With $1 million invested, one is no longer attempting to hit a home run. One is attempting to avoid striking out. A 20% loss with $50,000 invested represents a $10,000 setback. A 20% loss on $1 million represents $200,000 and potentially years of progress. Yet here manifests something fascinating about human psychology and money. Despite these new anxieties, most people who cross the $1 million threshold report feeling fundamentally more secure than they ever have in their lives. Not because the money eliminates all uncertainty, but because it provides a foundation that feels substantial enough to weather most storms. When one knows that investments could theoretically fund lifestyle indefinitely, it changes how every other risk in life is perceived. Job security becomes less critical when years of living expenses generate passive income. Health insurance gaps become less terrifying when substantial assets exist to cover unexpected medical costs. Economic recessions become less personally threatening when one owns assets that historically recover and grow over time. This security creates what might be called the optionality mindset. Every major life decision becomes a choice between multiple viable options rather than a desperate attempt to avoid financial ruin. Does one wish to live in an expensive city because the culture is beloved, or move somewhere cheaper to extend money further? Both become legitimate choices when baseline financial needs are covered. Does one wish to start a business that might fail or accept a steady job that might bore? With substantial invested capital, one can afford to bet on oneself in ways that would be reckless without that foundation. The worst-case scenario for most entrepreneurial ventures is not poverty. It is returning to one's previous lifestyle while investments continue generating income. This optionality extends to family decisions as well. Having children becomes less financially stressful when investments can help cover increased expenses. Supporting aging parents becomes more feasible when one is not living paycheck to paycheck. Taking time off for major life events does not threaten long-term financial security. The million-dollar threshold also activates what might be termed the compound acceleration effect. This is where the mathematical advantage of large capital amounts becomes almost absurd. If $1 million grows by merely 8% in a given year, $80,000 has been made without effort. That exceeds what many people contribute to retirement accounts over multiple years of aggressive saving. This acceleration means the second million often arrives much faster than the first. The initial million might require 15 to 20 years of disciplined saving and investing. But once that foundation exists, the combination of continued contributions and compound growth on the larger base can dramatically compress that timeline. Here emerges what truly separates millionaire investors from everyone else. They begin thinking about tax optimization as a core strategy rather than an afterthought. When investment gains generate substantial income, the difference between paying 15% versus 25% in taxes becomes enormous. Tax loss harvesting, asset location strategies, and retirement account optimization become worth the complexity because the dollar amounts involved justify the effort. The wealthy do not simply have more money, they have access to superior financial infrastructure. Private banking relationships, dedicated financial advisors, and sophisticated tax planning services all become economically viable when substantial assets require management. These services are not necessarily superior because they are expensive. They are superior because they are designed for people whose financial situations are complex enough to benefit from specialized expertise. But perhaps the most profound change occurring upon crossing the million-dollar threshold is how one thinks about legacy. While building the first 100,000, focus remains on personal financial security. With $1 million invested and growing faster than it can be spent, thoughts turn to what happens to this wealth beyond one's own lifetime. This is not simply about leaving money to children or charities. It is about understanding that something has been created that can outlive its creator and continue generating value for decades or even generations. Investments become less about funding personal lifestyle and more about stewarding capital that could impact multiple lives over extended periods. This shift in thinking affects everything from daily habits to long-term planning. When accumulating the first 100,000, every dollar feels precious because progress is slow and visible. Milestones are celebrated because they represent months or years of disciplined saving. But with $1 million generating $70,000 annually, one begins thinking about money in completely different units. Instead of counting individual dollars, one thinks in terms of months or years of financial independence. A $10,000 expense is no longer devastating because one knows investments will replace that money in less than 2 months. This creates what might be called financial breathing room, where short-term setbacks do not trigger the anxiety they once did. Yet here emerges something counterintuitive. The more money one has invested, the more opportunities exist to make even more money with less effort. It is as though the financial system contains secret levels that only unlock upon reaching certain thresholds, and most people have no idea these levels even exist. Consider leverage. With $20,000, banks perceive potential risk. With $1 million in liquid investments, banks begin perceiving a preferred customer. Suddenly, qualification for investment property loans with better terms materializes. Business lines of credit based on asset base become available. Access to margin lending permits borrowing against portfolios for opportunities without selling investments. This access to inexpensive capital is how the wealthy truly separate themselves from everyone else. They do not simply save their way to wealth. They use existing capital to acquire more capital-producing assets. It resembles possessing a key that unlocks doors most people do not even know exist. Real estate becomes an entirely different endeavor when substantial liquid investments exist. Instead of scraping together a down payment and hoping to qualify for a mortgage, one can move quickly on opportunities. Cash offers, bridge financing, and investment property acquisitions all become viable strategies with a million-dollar foundation. But perhaps the most significant change involves how one thinks about time and opportunity cost. While building toward the first million, every hour spent not earning feels wasteful. One constantly calculates whether vacation or hobby is worth the lost income potential. Once capital generates substantial returns. However, a realization occurs. Time might be more valuable than immediate earning capacity. This is when people begin making what seem like irrational financial decisions to outside observers. They might decline higher-paying positions because the work environment is toxic. They might take extended time off to travel or be with family. They might pursue passion projects that do not generate immediate income but provide personal fulfillment. From outside perspectives, these choices appear financially irresponsible. Why would someone with $1 million decline more money? But that is precisely the point. When basic financial needs are covered by passive income, optimization shifts from maximizing earnings to maximizing life satisfaction. The relationship with risk becomes completely inverted upon crossing this threshold. With limited capital, every investment decision feels crucial because no safety net exists. One poor choice could represent years of setback. But with substantial invested assets, one can afford calculated risks because the downside is manageable. This risk tolerance paradox is fascinating to observe. Those who can most afford to lose money are often the most conservative with core holdings while simultaneously being more aggressive with smaller portions of their portfolio. They might maintain 80% in stable diversified investments while using the remaining 20% for higher risk, higher reward opportunities. What proves particularly interesting is how this affects relationships with other people, especially around money conversations. While building wealth, one eagerly discusses strategies, shares insights, and learns from others in similar situations. But once substantial assets are accumulated, money conversations become more complicated. One cannot really complain about investment volatility when daily portfolio swings exceed most people's monthly salaries. One cannot discuss the stress of market downturns when lifestyle is not actually threatened. One certainly cannot talk about the burden of managing wealth when most people struggle to save anything at all. This creates a peculiar form of social isolation that many new millionaires do not anticipate. The financial concerns dominating most conversations become irrelevant to one's situation, while actual concerns sound like luxury problems to people still building their first 100,000. And so the truth reveals itself. The $1 million threshold is not merely about reaching a number. It is about crossing into a completely different financial reality where the fundamental rules governing money transform entirely. One transmutes from someone who trades time for money into someone whose money works harder than most people do at their jobs. The shift from accumulator to capital owner changes everything about how one thinks, works, and inhabits life itself. For those serious about building wealth, understanding this threshold provides a map for what becomes possible once the destination is reached. It is a journey not merely of accumulation, but of transformation, a crossing from one economic reality into another, where capital ceases to be pursued and begins, finally, to serve.